Harley Davidson just torched its own legacy by selling out to Wall Street. They pawned off $5 billion in loans for a $1.25 billion quick fix, sinking deeper into debt while riders felt betrayed. With future models flopping and the brand's identity collapsing, the so-called Freedom Machine is running on fumes. The kind of stunt they pulled makes you wonder if the people running the company even own a motorcycle helmet, let alone ride a bike. In July 2025, the so-called Kings of Freedom and Rebellion made the most corporate move imaginable. They sold off chunks of their financing arm, Harley Davidson Financial Services, better known as HDFS, to a couple of Wall Street giants. Not just any firms either. We're talking about KKR and PIMCO, the kind of names that make hedge fund bros clap while everyone else rolls their eyes. Each of these firms walked away with a neat 4.9% slice. So together they now own almost 10% of Harley's golden goose. That's not some side division selling t-shirts or mugs. This is the part of the business that makes it possible for riders to actually afford Harleys in the first place. But instead of keeping control, Harley decided to auction off a piece of it to the highest bidders. And let's not pretend this was just a polite equity deal and nothing else. Harley went full clearance sale mode. They also dumped more than $5 billion in existing retail loan receivables right into the laps of KKR and PIMCO. On top of that, they agreed that for the next 5 years, whenever a new rider signs up for a Harley loan, 2/3 of that business goes directly into Wall Street portfolios. 2/3. So if you thought buying a Harley meant you were signing up for a Freedom Machine, guess what? You're now also helping some guy in a $10,000 suit buy another house in the Hamptons. Of course, Harley's top brass dressed it up like it was genius. They called it a long-term funding solution, as if pawning your backbone to private equity is the new definition of stability. Riders didn't see stability, they saw a brand selling its soul. The real kicker? The stock market went absolutely nuts. Harley's stock jumped between 12 and 15.7% in just one day. That's the kind of move traders live for. The biggest spike since October 27th, 2020, when Harley managed a 22.1% surge on some earlier turnaround hype. So yes, Wall Street was cheering. But outside the boardrooms, people were shaking their heads, wondering when Harley stopped being about bikes and started being about balance sheets. Now let's talk about what Harley actually did with that $1.25 billion cash grab. They didn't use it to make bikes cheaper, better, or even more appealing to younger riders who think Harleys are what their uncle rides before mowing the lawn. Nope. They had a neat little spending plan already lined up. $450 million went to cutting down debt. Sure, that sounds responsible, but no one buys a Harley because the balance sheet looks good. The next chunk, $500 million, was shoved into accelerating a $1 billion share buyback program they had been hyping since last year. And finally, up to $300 million got earmarked for reinvestment, whatever that corporate catch-all means this week. Here's the part that makes investors drool. Those buybacks alone equal about 15.5% of Harley's entire $3.23 billion market cap. That's massive. It means they're using almost 1/6 of the company's value just to juice the stock price. Buybacks are Wall Street's version of steroids. They make earnings per share look healthier without the company actually getting stronger. Investors absolutely love it because it props up the ticker. Riders? Not so much, because nothing about this makes their bikes cheaper, cooler, or even more accessible. The same HDFS system that once helped working people finance their dream ride is now just a pipeline feeding returns to private equity. The valuation numbers made Wall Street clap even harder. The deal implied about a 1.75 times price-to-book value for HDFS. Harley bragged that its financing arm was worth more than its book value, so look at us, we're so valuable. But riders don't care about book value multiples. They care about whether they can afford a Sportster without selling a kidney. This entire deal basically screamed that Harley's priority is flattering the spreadsheet, not fueling the open road. And while the champagne corks were popping in New York, Harley's actual earnings painted an uglier picture than a dented gas tank. The second quarter of 2025 was nothing short of a disaster. Net income nosedived more than 50% year over year, collapsing to just $107.6 million. That's not a dip, that's a wipeout. Earnings per share plunged from $1.63 to 88 cents. And just to add salt to the wound, even the analysts, who usually set the bar low enough for a toddler to trip over, were expecting 96 cents. Harley couldn't even clear that. Revenue? Down nearly 19% year over year, landing at $1.31 billion. The motorcycle division specifically, the heart and soul of the business, was down 22.6%, barely scraping $1.04 billion. And then came the shipment numbers, which were nothing short of catastrophic. Shipments cratered by 28%. That's not just a bad quarter, that's 4 straight quarters of falling sales, an entire year of contraction. Imagine if your favorite restaurant kept serving fewer customers every single month for a year, but instead of fixing the menu, they bragged about selling the parking lot for quick cash. That's Harley right now. And here's the punchline. Wall Street may have loved the $1.25 billion infusion, but the actual sales curve is sliding faster than a drunk biker on black ice. The core business is shrinking, shipments are down, and riders are aging out. But sure, let's all clap because the stock ticker looked pretty for one day. What makes this whole thing sting is the contrast. On paper, Harley's leadership gets to parade around claiming they've engineered some genius financial move that ensures long-term stability. They point to the 1.75 price-to-book valuation, the 15% jump in stock price, and the debt reduction. But when you zoom out, what you actually see is a company patching gaping holes in its boat with dollar bills while the hull keeps cracking. 4 straight quarters of sales decline don't get erased by one flashy deal. Riders know it. They've always been the heartbeat of the Harley brand, the ones who bought into the lifestyle of rebellion and freedom. And now they're watching as their financing system, the very tool that made their bikes possible, gets sold piece by piece to Wall Street. Every time a new rider signs on the dotted line, 2/3 of that financing now belongs to private equity firms who couldn't tell a fat boy from a soft ale. That's not rebellion, that's surrender. So when Harley brags about its so-called long-term funding solution, the only long-term picture riders see is their brand being hollowed out. Harley can keep smiling while Wall Street toasts their innovation, but the numbers don't lie. Net income slashed in half, EPS down 46%, revenue down 19%, motorcycle revenue down 22%, and shipments down 28%. A full year of decline. That's not stability, that's desperation disguised as strategy. Harley once told the world it was ready to leap into the future with Livewire, the electric motorcycle that was supposed to hook younger, eco-conscious riders who wouldn't be caught dead on a gas-guzzling cruiser. It was pitched as the bridge between Harley's rebellious past and its high-tech future. Except instead of a bridge, it turned out to be a rickety plank that collapsed the second someone tried to walk on it. In the second quarter of 2025, Livewire sales didn't just dip, they fell off a cliff. Sales plunged 65.2% year over year, and the absolute number? A laughable 55 units sold worldwide in the entire quarter. 55. You could round up all those buyers, seat them in a mid-sized diner, and still have room left over for the waitstaff and a jukebox. This was supposed to be Harley's moonshot into the future, but it looks more like a failed science fair project. Meanwhile, Tesla is out there selling hundreds of thousands of electric cars every year, and other EV brands are putting out bikes that, at the very least, break into 4 digits. Harley couldn't even crack 3. That's not just embarrassing, that's humiliating. And rather than fix the Livewire disaster with innovation, design, or pricing that actually speaks to the market, Harley leaned harder on financial engineering to keep its investors happy. It's like burning dinner in the kitchen, and instead of making a new meal, You spray perfume around the house and hope nobody notices the smoke. The failure of Livewire is more than just a bad product launch. It's a perfect symbol of how Harley is out of touch with the next generation. Think about it. The younger riders Harley desperately needs are already skeptical. They don't want to spend 25 grand on a hulking, outdated cruiser that screams midlife crisis louder than it revs. They want innovation, affordability, something that feels like the future. Livewire could have been that answer, but instead it became a punchline. And now, instead of motorcycles leading the way, Harley's stock price is being propped up by the same kind of Wall Street deal-making they used to flip off in their marketing. For a company that once prided itself on rebellion, nothing says, "We're lost," quite like selling 55 bikes in a quarter and calling it a strategy. This leads us straight into the bigger problem: Harley's identity crisis. For over a century, since 1903, Harley was the ultimate symbol of freedom, grit, and rebellion. Leather jackets, roaring engines, the open road. That was the brand. But in 2025, the big headline wasn't about a new legendary bike or even a successful turnaround. It was about Harley selling a piece of its own financing arm to private equity firms in $1,000 suits. The same Harley that built its empire by telling the world it was anti-corporate now has KKR and PIMCO sitting in the sidecar. Riders see that, and they don't see innovation. They see betrayal. Financing a Harley now doesn't feel like a dealer handshake or a brotherhood of riders. It feels like underwriting a hedge fund manager's next yacht. The cultural divide is brutal. The older loyalists who kept Harley alive through the decades feel abandoned, watching the brand they defended at rallies and barbecues morph into something unrecognizable. At the same time, younger riders aren't buying the nostalgia act. They see $25,000 gas guzzlers and laugh. For them, Harley isn't cool rebellion anymore. It's their uncle's weekend toy. The one parked in the garage under a cover while the younger crowd zips around on electric scooters or Teslas. Harley has managed the impressive feat of alienating both its core and its future in one go. And what's left? A company that looks less like a motorcycle manufacturer and more like a finance firm that happens to build bikes on the side. If you need proof, just look at where the money is going. Not into Livewire fixes, not into groundbreaking design, but into buybacks and balance sheets. And now, let's talk about where this road is actually leading. Sure, Harley can puff its chest and brag about unlocking $1.25 billion in quick cash. They can point to the short-term stock bump and pat themselves on the back for making the ticker look healthy. But peel back the curtain, and what do you see? Sales are still declining. Tariffs alone chewed up $13 million in the second quarter of 2025, and the customer base is aging faster than the chrome on a neglected Softail. The buybacks make shareholders smile, but they don't sell bikes. The Wall Street valuation games flatter the numbers, but they don't bring in younger riders. The company may be surviving on accounting tricks, but it's not thriving on the showroom floor. Investors win in this game, at least for now. They get the premium valuations, the boosted earnings per share, the feel-good quarterly reports. But riders? They're losing faith in a brand that once meant grit, rebellion, and sticking it to the establishment. Every time Harley outsources 2/3 of future loan originations to KKR and PIMCO, it's not just a balance sheet decision. It's mortgaging the customer base. It's handing the keys of the Harley dream over to the same kind of corporate suits the brand once defined itself against. That's not innovation. That's desperation wrapped up in a glossy investor presentation. Hit that subscribe button because Harley's downfall is just getting started, and you won't want to miss the next twist in this corporate crash and burn.